right, good afternoon. All right, I'm going to try that again. Are there any Aggies in the house? Whoop! All right, there we go. See, you just had to do it the right way and you get everyone. All right, thanks for having me here this afternoon. I'm glad so many of you came back for this late afternoon session. We only have about 20-25 minutes to go through stuff, and I am from Texas, but I can speak really quickly if I need to. So get your caffeine choice, your drink that you like. Mine's Diet Coke, but I'm already had enough Diet Coke today, so I am ready to go. We are going to jump in here. As Eric told you, my name is Victoria Fernandez. I am a portfolio manager and chief market strategist at Crossmark Global Investments. Our home office is down in Houston, so come on down whenever you would like. And we actually are a faith-based firm, so we try to really help clients that are interested in matching their investments with their values. And hopefully, let's see, maybe about 3 weeks ago, I don't know if you guys watched Charles's Making Money show, where it was a whole hour of faith-based investing. Did anyone watch that? Yeah, great. 2, 3, 4. Okay, good. So you probably saw me and my CEO, Bob Dahl. We were on there together talking about values-based investing. So if you haven't thought of that before, just a quick plug, go back, watch that show. I think you might find it pretty interesting. So, all right, I'm assuming this is what I'm using to move these. Looky there. All right, let's dive in. Last year, 2024. Not a bad year. You got about 25% return. You look in the middle of this chart right there, the S&P 500 total return index. But look at the line right below it. The equally weighted index is about half of that. It was at 13%. So we look at last year as a whole and say, yeah, it was a pretty good year. The market did great. And then we realized that there was a lot of concentration there. And we all know where that concentration was. What was that group of stocks that really led the market last year? Ah, look at you. All right, the Mag 7, that's exactly it. And so for us at Crossmark, when our investment team sat around, we would get a little concerned that just a handful of stocks, 7, 8 stocks, depending on if you wanted to include a couple extras in there, were really driving this market. It gave us a little bit of concern as we moved into 2025, and it set the bar really high for 2025. There was really a market that was priced for perfection. So we came into this year with extremely high valuations. We'll look at a chart on that in just a little bit, with very high earnings expectations and very high growth expectations. Some of that having to do with the fact that we had an election and a new administration was coming in that was considered very pro-business, very business-friendly, market-friendly, and so there was a lot of animal spirits driving the markets and setting us up really to be priced for perfection as we started this year. You can see some of the elements here that help set that bar high. Growth expectations, like I mentioned. Lots of rate cuts people thought we were going to have. Do you remember how many rate cuts people were thinking and had priced into the market coming into this year? It was like 6 or 7 rate cuts that people thought. That seemed a little much for us at Crossmark. We were thinking maybe 2 is what we were looking at. So we assumed there'd be some volatility in this market as things got priced back out of the market. Long-term inflation expectations. The market assumed we were going to be back down at 2% and the Fed was going to be happy and everything was going to be happy. We know that that hasn't been quite the case, and we knew with the new administration coming in, there would be a lot of uncertainty around the policies that were there. Not necessarily good or bad, just uncertainty as to what would happen. So this is kind of how the bar was set. These expectations were really built on some well-supported premises by the market and by investors. These are the premises coming into this year. The U.S. was going to remain the global growth engine. We always like to think we're the best house on the block, right? And that was the thought coming in to 2025. We actually thought the business cycle, even though it was, long in the tooth a little bit, it was going to continue to expand. We use our baseball analogy. We were in the 7th, 8th inning maybe of this robust market, but there was still a little bit to go. We thought central banks would lower rates. AI was going to come in. I heard y'all just had a great session on some AI stuff, that was going to be a great CapEx boom for this market, really drive things. We all know the drill, baby, drill phrase, right? We were going to get more oil supply, lower energy prices, earnings growth was going to broaden. We were going to have this great foreign policy, this America First policy. All of these things really built us up coming into this year with animal spirits, like I said, following the election, supporting all of this. But as we sat around the table as an investment team, we thought, there's some cautionary flags out there that I don't think people are pricing into the market. So we had to look and see what those were and how that was going to affect our market outlook and the investments that we were going to make this year. So here are the cautionary flags we saw at the beginning of this year, and we've already seen some of them. I know Charles told you all earlier he didn't update his slides. I didn't update mine either. So some of these you're going to go, oh, well, that's already happened. But this is what we looked at coming into the year. Consumer sentiment. Yeah, we were concerned about consumer sentiment. We were already seeing some things that were telling us maybe consumers were a little bit concerned about what was going on in the economy, that they weren't spending quite as much. We'll look at that a little bit more in a minute. Inflation. We didn't believe that inflation was going to continue to come down. There was some stickiness to inflation. And take tariffs out of the equation. This is kind of before the idea of all the tariffs coming in. We thought services inflation was going to continue to move a little bit higher. Goods inflation might move a little bit higher. We saw inflation expectations move higher. Now, this is important because this is where you get kind of a self-fulfilling prophecy. Inflation expectations, what people think is going to happen in the future. We look at the latest report that came out. Inflation in 1 year, people expect it to be 5%. That is the highest people have thought since November of 22. 5-year inflation expectation, what they think it's going to be 5 years from now, 4.1%. Highest level of inflation expectations since 1993. So those are going higher. And you know how you don't always react to what happens, you react to what you think is going to happen in the future, right? That's the self-fulfilling prophecy. As consumers are thinking inflation is going to get higher, we were concerned that that was going to start to affect their spending habits. And we know we are in an economy that is 75% consumer-led. So it, again, made us look at some cautionary flags. We thought market leadership would change those Mag 7 stocks. There were signs that they were going to come out of leadership. Free cash flow was down. Earnings expectations were coming down. We were ready to see some market rotation, and we have absolutely seen that happen. We knew, again, policy uncertainty, and we saw weakness in the labor market. It's interesting, when I do interviews, if the person interviewing me doesn't agree with me, they're very adamant about it, right? And this is the one that at the end of last year and beginning of this year, I got a lot of pushback on. They were like, well, we keep creating jobs. Everything is great. Yeah, but there's a lot of underlying elements that are telling us this labor market is weakening. Job openings were coming down. Hiring was slowing. Layoffs were slowly creeping up. The employment to population ratio was coming down. Some things that said labor market's going to weaken, and again, that means consumer spending is going to go down. So it led us to be cautious, and there were 3 areas that really solidified this for us. We're talking about the consumer, and you see that right there. That is our first one. Consumption is slowing. Listen to earnings calls, and just most of you probably know, come Friday, we're going to really kick off earnings in earnest, right, with the banks. So get ready for all those calls. Home Depot, Lowe's, Dollar General, Dollar Tree, Target, all of these CEOs were on their earnings calls talking about the concern around consumer spending. Walmart was like, well, I don't know what's wrong with them. Everything's great. Well, Walmart was great because they were bringing in high-income consumers into their stores that they usually did not have, but it's because consumers were worried. They were shifting their spending habits. I want to ask a question here. I like to be interactive. Credit card interest, not your actual payment, but the interest on your credit card balance. How much do you think that is of a household's disposable income? Too much is absolutely right. Who said too much? Yes, absolutely right. It's up to 7%. 7% of your disposable income is just on interest on your credit card. That leads us to some concern on consumers. Student loan debt. Delinquencies have gone up 15% since they started requiring payments again. So again, elements as to why the consumer is slowing. And what does the consumer depend on? Depends on the labor market. That's our second reason we were cautious. Labor market is softening. And look, one of the important things about the labor market is that there's two different components to it, the cyclical component and the non-cyclical component. We want to look at how many of the jobs being created are cyclical jobs, retail jobs, transportation jobs. These are the things that increase when the economy is doing well. The non-cyclical jobs, government, healthcare, education, that's not where you want to see the biggest growth in your jobs if you're looking at it as a key to how the economy is doing. Over the last 2 years, what percent of jobs created do you think were non-cyclical jobs? Throw out that's your answer on all this, isn't it? Too many. Anyone have an idea? What do you think non-cyclical jobs, how much that's been of the labor market growth? Over 80%. So if we're looking at that and we say, wait, less than 20% of the jobs created are in cyclical jobs that are supportive of the economy, again, leads us to be a little bit concerned as we're seeing layoffs go higher. So this is obviously going to give us a concern for earnings and the valuations that we see coming. We're going to go quickly through some of this because I know we're already running out of time, but just look at that second column. This is the S&P 500 index. Valuation metrics are on the left. Every valuation metrics that you can think of that you might look at for stocks, look where they are on the historical percentile chart. 89, 95, 99, 84, 96. These are extremely high levels. So the valuations of stocks and of the market in general were extremely high, and this made us nervous. Always look at inflation. We know inflation numbers came in a little bit higher than expected over the last couple of weeks, and we think there are risks to the inflation call, higher and lower. Those are listed at the bottom there. I'm not going to read them off to you, but there's lots of moving parts, again, that give us some cautionary warnings. So what does this mean for the fixed income markets? You knew, look, I'm a bond girl. You knew I was going to bring it back to fixed income markets here at some point. So what does all this mean for fixed income? Look at this chart. The green line is the 3-month Treasury bill. The light blue line is the 2-year, and the dark blue line is the 10-year. You can see back starting in the fourth quarter of last year, yields started to move up on the 2-year and the 10-year. That reflects, the short end of the curve reflects kind of what the Federal Reserve is doing. The longer end, the 10-year and longer, reflects more what inflation expectations are. So you can see there was a lot of movement and how we're coming back down at the end. If we had done this through yesterday, that line would have been even lower. But it's because people are questioning, what is growth going to be going forward? What is inflation going to be? What is the Fed going to do? What does liquidity in this market look like? All sorts of things can affect yields. Here's a whole bunch of them that could move rates higher or lower. And as a fixed income portfolio manager, I have to try to measure these to determine how do I want to position my clients. Do I want to reduce my interest rate risk in portfolios? Do I want to add it? Do I want to be in corporates? Do I want to be in treasuries? What do I want to do? Here's some of the things that we have. Rates could go higher if inflation is sticky. If tariffs add to inflation, a stronger economy can drive it higher, productivity. But we also have on the other side of the balance things that could drive rates lower. Maybe we do get closer to 2% inflation. Maybe the concerns around tariffs moderate. Wouldn't that be nice if we woke up Monday morning and concerns around tariffs had moderated? I mean, fingers crossed, guys. I don't know. We'll see. Labor markets could weaken even further. We've already started to see some of that. The Fed could do some things with their balance sheet, or our deficit could be improved. Someone earlier, I don't remember who, was talking about Treasury Secretary Bessent. I adore him. I'm so glad he's in this administration, and this is his goal, is to improve the deficit. And if he does, we get a lower cost of capital, yields come down. So lots of movement in the yield market. Here's a quick example. Just look at that first column. From the election to the peak of rates in 2025, which was like January 19th or so, 10-year Treasury yields moved up 36 basis points, so 0.36. from January 19th to the end of February, we moved down almost 50. Lots of volatility that we have in the market, and we've seen that volatility in corporate spreads as well. When you talk about corporate spreads, when people are concerned about the market, spreads widen. That tells us there's concern that maybe companies can't pay back that principal or pay the interest, the coupon on their bonds that they have. When spreads tighten, that means they're not as concerned, right? The market is stronger. They feel like there's a lot of support there. For the high yield fixed income credit markets, we have seen those spreads widen tremendously over the last few weeks. There is a lot of concern around high yield. It's why we don't buy it for our clients. I'm not saying you can't buy it. It all depends on your risk tolerance and what you're trying to do. But it's why we're sticking with the higher quality, more investment grade credit for our clients, because those spreads have not widened out. You will hear a lot of people on the networks say, the economy's fine because spreads haven't widened out. Well, we saw in the last couple days, maybe that's not so much the truth. But corporate credit spreads is something we really want to watch. And if you are a little bit risk averse, look to stay more on that investment grade side. Buy some individual bonds, have those in your portfolio, generate some cash flow and some income off of those, really kind of have your own investment story by doing that. So let's wrap this up. We only have a couple minutes left. And again, now here we go. We're going to talk really quickly. Conclusions that we have for 2025. In the beginning of the year, we thought the equity bull market's not over, but it's getting long in the tooth. We talked about that. Well, like I said, we didn't update these slides over the last couple days. We can tell that bull market has come back quite a bit. We don't think inflation is going to fall, so it puts the Fed in a very tight spot on whether they should raise rates or lower rates. We think earnings will fall short of expectations. We've been waiting for that over the last couple quarters. This might be the quarter that we start to hear CEOs say that. Listen to those conference calls and see what they say. We do think some stocks are very expensive, so you have to pay attention to that. Expect some high volatility, and we knew that there would be volatility in that first year of the administration, and we've actually seen that come to fruition. So what do we do with all of that information? How does that mean anything to us from an investment perspective? This is what we're doing for our clients, and this is kind of a foundation or a framework that we would say you can use in your investments as well. Expect choppy markets and be able to move on those markets. Buy some dips, trim some rallies. Our CEO, Bob Dahl, says, don't be afraid to take a bow and take some money off the table when you've done well. It's a smart way to invest. Expect lower returns. I never like to be the Debbie Downer of the party, but I am going to tell you, our investment team believes that for the next 5 years, you're looking at an average return in the equity markets of about 5% each year. I know we loved 25%. We wish we could do it more, but I just don't think that's what we're going to see. Focus on earnings growth and free cash flow. When you have days like the last 2 trading days, you want the companies that can withstand that have strong balance sheets. Focus on free cash flow and on their earnings growth. That's going to give them the stability to do better than other names and withstand that. Diversify across your asset classes. People go, bonds are boring. Why do I need that? It just hurts my ears. It's like nails on a chalkboard to hear that. They're not boring. Make sure you diversify. Fixed income will help buffer some volatility you see in the equity market. Real estate can help buffer maybe something that you're seeing in the currency market. Have that diversification. Consider an absolute return strategy, which is like a long-short strategy that helps you do maybe a little bit better than cash. That's something we do for our clients as well. And the very last thing I'm going to say here is number 7, step up when you see some significant weakness. Anybody seen significant weakness lately? I would take this as an opportunity. I am not saying that we are at a tradable bottom. I am not saying we are at the low of the markets. What I am saying, though, is if you find some of the companies right now that have that good free cash flow, have good earnings expectations, those prices have come down, then that's an opportunity for you to build out your portfolio. It's what we're doing for our clients. I hope this provides a good framework that you can use for your investments. Thank you so much for having me today, and I look forward to being back at a Money Show again.
Oh, am I on? How about that for Victoria, an Aggie? Thank you. Now